This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Grant Williams joining us from Singapore. Grant is a portfolio manager and well-recognized author of the newsletter Things That Make You Go, Welcome, Grant.
Hey, Gordon, it's good to be with you.
Grant, maybe we can kick it off by you giving our listeners a brief overview of your background and the things that you're currently involved with.
Sure. Look, I've been involved in financial markets for it'll be 30 years next year, which makes me feel very, very old. But
that doesn't sound very old to me, Grant.
Well, I started in the city of London back in 1986 and 85. God, and I spent time in Japan, living in Tokyo. I lived in Hong Kong, Sydney, New York, and now here I am in Singapore. Primarily equities, but I've traded bonds in various places around the world. And I started writing Things That Make You Go about 5 years ago, which was just, some of my friends call it a cry for help, just try and get some confusion cleared up, just put my thoughts out there, and it's snowballed. And since then, we've just launched Real Vision Television, which is, again, an attempt to try and bring some truth back to finance by interviewing some of the smartest financial minds we can find, similar to what you're trying to do, educate people and give them a chance in what are perhaps the most challenging financial times the world's ever seen, frankly.
Absolutely. It's a challenging time, but I would argue, too, some of the best times for investors if you're really paying attention. And I say that in the context, I think the Federal Reserve is trapped in many ways into some of the things they're doing. And for the last, I would say 36 months, it's been a pretty clear R-squared fit with what the Fed's balance sheet does and what the S&P's been doing. So that makes it pretty easy, though it's getting a little turbulent right now. Grant, the purpose of the show is to talk about financial repression. And I wonder if you could explain to our listeners, in your words, what financial repression is and what it means to you.
Well, I think I'm a great reader of the dictionary. It's one of my favorite books, and I think if you go and look up the word repression, you're not going to find financial associated with it. But it's essentially the business of trying to repress feelings that are supposedly unwanted or undesirable. And I think it was 1973, a couple of Harvard professors coined this term financial repression, which for them was essentially a way of the government trying to steer capital in a way that benefited them, and in that particular study helped them pay down their debts. But what we're essentially getting here now is outright theft from savers to borrowers, because I've spoken about this at length around the world. The pool of savings on Earth is the last really untapped pool of capital that governments have got to go after, and this all stems from a slide here that I want to show the viewers, which is a slide of the growth in credit and the growth in GDP over the last 40 odd years. And actually, can I do that again? Sorry, because it's not 40 years. I'll bring this chart up so I know what I'm talking about. And I want to reference one of the charts here that we've prepared for this discussion, Gordon. That's a chart of the total credit going back to 1929 versus US GDP. And as you can see from the chart here, what we've essentially had is just this explosion in credit. And a lot of that's done through financial engineering. Most of it's done by keeping interest rates low. And since the 80s, you can see there where the two charts begin to diverge. That was where the gold window was closed by Nixon in '71, and then a little after that, when the lines really begin to diverge, that's when interest rates peaked in the late '70s, early '80s at 18% in the US. And since then, you've had this explosion in credit, and it's been dressed up as a powerhouse economy. And this doesn't just stand for the United States. I'm using this chart as illustrative purposes, but many, many countries in the West have similar charts. And you can see the two circles there. That's basically the global financial crisis. So you can see there the tiny dent in this expanding credit bubble that caused all the problems in '08, and you can see the tiny dent it made in GDP growth.
And this was the global deleveraging in this little circle here?
Yeah, exactly. I mean, look, since 2007, there's $21.6 trillion of debt been added to the debt pile around the world, and that's in an age of deleveraging and austerity. So the world is essentially now addicted to this debt, and what 2008 was a large red flag saying, hey, unless you do something, these two lines are going to begin to converge pretty fast. And unfortunately, there's no way you can artificially change that blue line, the GDP growth line. That's going to go where growth takes it. You can monkey around with the figures, but you can't create the kind of line that you've seen with the credit line there, because that's all through financial engineering and interest rate policy. So 2008 said those two lines want to come together again. That would be an absolute unmitigated disaster for the world, as you can see by the scale of the financial crisis there. So that debt hasn't been expunged, it hasn't been defaulted on, it hasn't been paid down. And so governments around the world are being forced into financial repression to try and debase their currencies, to lessen the amount of debt they have through inflation. And to do that, they have to attack the one pool of capital left in the world, and that's the world's savings, which it's incredibly unfair on anyone that's saved their money. But it's, as you said at the beginning of this, that the Fed is trapped, the Bank of England is trapped, the Bank of Japan is trapped, they're all trapped. And what amazes me is that people think there is some way out of this trap, maybe without any kind of pain, without we're going to find some magical organic growth from somewhere that's going to ease the burden. It's not. We are in a trap, and the only way out of this trap is for something to happen to these two lines. And unfortunately, the only way they can get the money to do it is from your pocket and my pocket and the pockets of anyone that's actually been diligent and prudent and saved some money over the years.
We have 75 million baby boomers in the United States about to retire, 10,000 a day that won't be contributing and will be withdrawing. That's a lot of extra money that's got to be financed. So financial repression, lower interest rates, it's all aimed at trying to pay that. But where's the money going to come from? It's going to come from the pensions. It's going to come from the savers, etc. It is a transfer. You have transfer.
It is a transfer, and it's the most insidious kind of transfer, because it's a transfer that the vast majority of people don't understand. And so,
could you help them? Could you help them with that, Grant? Because I think a lot of people have problems understanding what negative real interest rates mean, and that in fact the money is transferred. It is shifting. They just think it's disappearing.
It is, and Gordon, it's funny. I've over the years put a lot of charts together. I put a lot of fancy charts when I do presentations all around the world, and I take a great amount of time over them. But by far, the biggest single reaction that I got from any chart, I'm going to show you that chart in a second here, which it was in a presentation I gave a couple of years ago on the west coast of America. But if you look at this next chart of 2-year interest rates here in the United States, you'll see that as we go back to 2006, we're not going back a long way here. We're going back 8 years. 2006, you could get 5.23% interest on a US 2-year Treasury bond. So if you had some savings, you could put them into the safest instrument essentially on the planet, with the exception possibly of gold, and we'll come to that, I'm sure, at some point in this conversation. And you could earn a real rate of interest, 5%. Now, since 2008, you can see up from the chart here, that blue line there is the recession. And where the blue line ends on the right, supposedly, according to the National Bureau of Economic Research, that's where the recession ended. And yet, here we are still with rates going lower constantly after that. And you can see that second box there at the bottom, 0.2% was the low in September 2011. So what does that mean in real terms? Well, this next slide will show you. And when I first put this slide up, I literally had gasps from the audience, because I think a penny dropped. If you had $10 million invested in US Treasuries, 2-year Treasuries back in June 2006, you would have $523,000 of interest income coming in for you to live on. So you could have your nest egg, you could live off the interest, live a very comfortable life, and the money would do exactly what it was supposed to do when you saved it. In 2011 there, that same $10 million, you were getting $20,000 of interest. And this chart is the single best way I've found of trying to explain financial repression to people. The interest income that you thought you were going to receive when you planned your retirement, when you saved your nest egg, has been arbitrarily confiscated by governments around the world. And we're using the US here, it's happening everywhere. To the extent that they're forcing you to put your money at risk into markets, into assets, somewhere to get that market out into the economy to try and generate this growth they need in order to stop those lines converging the wrong way. And so this to me is the single best illustration. Rich people, we get all this talk about the 1%, rich people aren't rich anymore because they're being forced to spend their capital, which is not what rich people do. Rich people are smart and they live off the interest. Spending your capital is not a smart thing to do.
Grant, I can put all sorts of personal friends' names beside this chart that you're showing. And these are people who built businesses, saved, worked all their lives, were very prudent in their financial planning for the retirement. And they were told at the time what they thought they could get, but they were told to plan 6% return on their money, and that's what they should be able to live on. And they thought they were being prudent. And now when I say 6%, we kind of roll our eyes and say, and where do you get that? Well, these same people now have been retired a numbers of years, and they're being forced to go back to work or to find other kinds of income because they're terrified. They're now burning through their capital at such a rate. Not only aren't they getting that income, but in their world, they're seeing real inflation eating away at it. So there's no question in their mind what's happening. And another point I would make, I see with the middle class that's being gutted in America. They're lucky if they keep their jobs, but to get to 2% salary increase is quite significant. But minimally, I would say inflation is 8 to 9% in America. But let's just say it's 5%. That's a 3% loss that they're compounding and losing ground at every day. But they're making their money under earned income, wages, and they're getting crushed. Financial repression says that with negative real interest rates, the wealthy don't make their money, and I'm not picking on the wealthy, I'm just showing how the money's transferred. Those who have debt and leveraged debt. So those who don't make their money under earned income, they make it under capital gains or investment or increases in assets. They borrow money, the Federal Reserve, primary dealers at 0.5%, but let's say their money costs them 2%. And let's say they only get 5%. They're making 3%. When I say 5%, that's what they make. With inflation, because inflation is going to 5%. So they're making 3%, whereas the worker is in fact losing the 3%. That's about as clear as you can make of what's effectively happening. And so anybody who's highly leveraged right now with debt instruments is winning temporarily as they take on more and more risk. Does that pass your common sense test, Grant?
Well, yes, they're winning for the time being. And
for the time being, I'd be really careful with that one.
Yeah, no, absolutely. And I think when we talk about this, and it's a subject that comes up a lot, I think it's important to understand that there's this skewed perspective about this because of the bank bailouts in 2008. And so there's this sense that, people who are over-leveraged and over-indebted will get bailed out by the government. And that's not necessarily the case. Now, that happened because they were, quote-unquote, systemically important organizations, and they felt like they had to bail the banks out, and they certainly had to do something. I think they could have handled it perhaps better. But at some point, the business cycle, which the central banks have tried so hard to suppress the downward half of the business cycle for reasons that we've expanded upon because of this massive debt cycle, at some point, these are natural forces, and forces of nature can't be altered. They are permanent. And so you can monkey around with the business cycle, you can mess around with interest rates, you can do what you can to repress the natural order of things, but ultimately you're not going to succeed. I read a piece in the newspaper a couple of days ago which quoted a Bank of England governor saying that there was a chance interest rates would stay low permanently. Now, we all know that that's not the way things work. You can't have permanently low interest rates. And yet, what frightens me is that, these guys that run the central banks around the world are saying things like that out loud. Are they trying to convince people because they have to, or do they genuinely believe that we've entered this new paradigm where interest rates stay low forever. Irving Fisher in 1929 said stocks had reached a permanently high plateau, and we know how that ended. Permanence in human nature is just not there. And so at some point, the forces of the business cycle are going to reassert themselves. At some point, the build-up of tension as they've repressed the natural order of things is going to come back, and it's going to unleash itself in a way far worse than it would have done had they just let these recessions occur. When did recession become such a bad word? Recessions have been happening throughout economic history, and the world still goes on. We had the Great Depression. The world, found its feet and grew again. So since that initial chart I showed you, because of the disparity between credit and growth, that's why these guys are so afraid of letting an ordinary recession take place, because an ordinary recession could turn into a depression. And when I speak about it around the world, I gave a presentation on this here in Singapore a couple of weeks ago, and someone sat through it, and he said to at the end, okay, so what's the good news? And I said, look, the good news is actually very good news. Whatever happens, the human race is going to survive. The world's not going to end if we have a recession. The world won't end if we have a depression. It'll be god-awful. But the more you suppress these things, the more you repress the forces of nature, the worse it's going to be in the end. And I'm genuinely concerned at how bad this could get when we start to see the wheels come off this thing again, because with rates at zero, the only thing left are capital controls and all kinds of financial repression. In the long run, even they're not going to work, I'm afraid.
The business cycle is a cleansing and a healthy mechanism, because what it does is it forces out the malinvestment, which starts to creep in the system. You get proper price discovery, and you get the proper pricing of risk. If you extend it for a period of time, both of those start to consume, and the malinvestment consumes available capital. And the capitalist system is about having savings that's reinvested. So when consumption's eating up all the savings, and you've got non-performing debt starting to eat away at it, you don't have investment, and then you get aggregate demand that starts to slow. I'm being a little simplistic here, but this is the essence of why you need to go through this cycle, and we're doing everything to stop it. And by printing money and going to an unsound money structure, you make it much, much worse, and you have less options available when the inevitable occurs and must occur. But I guess the question is, are we still in a capitalist system? Richard Duncan argues we're in a credit system.
It's a great question, and I think that the evidence is there for all to see. I mean, people can draw their own conclusions. But I think from a big picture of this, this whole idea of financial repression is really governments attempting to bail themselves out of the corner that they've got themselves into by allowing these huge debts to build up. It's a stealth tax on people, and unfortunately, the average person isn't engaged enough in economics to really understand what's going on. In fact, Keynes wrote in The Economic Consequences of Peace in 1929, how pernicious inflation was. The words he used were not, you can inflate away, I'm paraphrasing, you can inflate away these debts, and quote, not one man in a million will be able to determine what you're doing. And that's exactly right, and that's why they do this, because they understand that it's a numbers game, and there are plenty of people engaged in finance, either professionally or keen private investors who really do understand this. But the advantage that the authorities, the central banks, the governments have is that not one man in a million can really determine what they're doing. So when you hear talk about inflation's at 1.2%, people take that as read. Instinctively they understand that it kind of feels like things are a lot more expensive than they used to be. And they might pinpoint one or two. They might pinpoint that the gas bills are going up, or their electricity bills are going up, or it costs more to fill the car up. But when you're continually told by the government, who the vast majority of people trust implicitly, that inflation is 1.2%, you tend not to go through the exercise of saying, hang on a second, I'm going to challenge that. I'm going to sit down and I'm going to work out exactly what my cost of living is going up every year. Until the point you get to where you are retired, you're living off your savings, and suddenly it becomes very, very obvious exactly what's going on and how much your cost of living is going, because you're not getting income. You can't just manage it. You're watching your capital get eaten into and dwindling. And so I think that's why you're starting to get this group of people waking up who have retired or who are on the cusp of retiring, and since 2008 realize, you know what, I can't retire anymore. And that's why you're seeing, you know, the 55 plus age demographic is the fastest growing, as you pointed out earlier on, it's the fastest growing demographic in terms of jobs in America, because people have been forced to go back to work. So this idea of financial repression, it's a stealth tax on people who the authorities are assuming won't realize what's going on, which, as I said, makes it so much more insidious.
What should investors be doing, Grant? If they know this and understand it as well as you do, what would you advise them to do? Well,
I think the important thing here is to be flexible, because as we've seen since 2009, we've seen a tremendous bull market in stocks. You know, the S&P is up almost 200% since the depths of March '09. So nominally, that's great, and a lot of people are riding that, but crowds tend to kind of get sucked in and not be smart when it's time to take money off the table. And if you look at this next chart that I want to bring up here, which is the S&P 500 deflated by quantitative easing. So essentially, I'm going to divide the S&P 500 by the size of the Federal Reserve balance sheet, which will give you a real sense of what the S&P's done in real terms because of the quantitative easing. And as you can see from this chart, those arrows there on the bottom right corner, the S&P has essentially gone sideways in relation to the Federal Reserve balance sheet, even though nominally stocks have gone up 200%. So people that have been in the stock market and have enjoyed this great bull market, there's a lot of very smart guys that didn't believe it at first, kind of got sucked in and said, okay, it's going up, we need to play here. But more and more, we've seen a wobble these last couple of weeks. People are starting to realize that something's not right. And so, smart investors, the people who are going to navigate this, you need to have the flexibility and the ability to say, you know what, I'm going to leave some money on the table here because I'm nervous. I think there's some funny things going on. It doesn't feel right. I'm going to take my money out of the markets and I'm going to sit in cash. And I was speaking on a panel in Canada a few weeks ago, and this very subject came up. They were talking about what would you do with the money, and I said, look, to me right now, this was before we've had this recent wobble. I said, to me right now, the risk reward of being in these markets just isn't there. Yes, the rally could continue, but at all-time highs, with a lot of the internal plumbing that we're seeing looking decidedly shaky, for me, it's time to be in cash, and I'm very happy to sit in cash, even though I know that that's costing me money. If I sit in cash for the next 3 months, let's say it costs me 0.5% or 1%, it's a guaranteed loss I'm going to take in real terms. I think there's a good chance that during those 3 months or 6 months, I could be able to buy things 20% below where they are right now, because we're going to get some kind of major correction. And people are afraid to be out of markets. They're afraid to listen to their neighbor telling them, they're making all this money in their tech stocks or in their biotech stocks. And there's this, someone coined the phrase FOMO, fear of missing out. And it's so true. And we saw it at the height of the NASDAQ bubble in 1999-2000. I remember being in the canteen in New York on a day when I think it was Cisco, or Lucent, remember those, had fallen 20% on bad earnings. And I heard two guys chatting behind me in the queue for food, and one of them said, you saw these Cisco numbers today? Yeah, he said, I'm so pleased. I thought I'd missed it, now I can get back in. And there was no, I need to look at the numbers and find out what's happened here. I need to work out why this stock's fallen 20%. It was great. I thought I'd missed it. I can get back in. So normal investors need to have the courage to step away from these markets and say, look, it's going up. I've made some really good money here. I don't really know why, because it doesn't feel great. I'm listening to the pundits tell me it's good, but it just doesn't feel right. Being in cash or a large proportion of cash is a very, very brave but very smart thing to do at various points in time, and I think we're there. Also, gold is something that I speak about a lot around the world, and I think gold's perhaps the most misunderstood asset class out there. A lot of that comes from the fact that you can't value it like a traditional asset. You can't value it like a stock or like a bond. It's very much an emotional asset. And I think having gold as part of your portfolio, forget the price of gold, forget whether it's gone from 1150 to 1500 or from 1900 back down to 1200. Having a percentage of your assets in something that that can't be created out of thin air. It's just a sensible insurance policy. I call it the insurance policy. Depending on how unsure you are about the outcome of this whole thing, that's about how much money you should have in gold. If you think there's a 10% chance that the wheels can fall off, put 10% of your money in gold, because it will be worth something when all this is said and done. It is a real asset, and it has 6,000 years of financial history behind it. It's not going to go to zero. So try not to worry about the price and just use it as an insurance policy.
When you say gold, Grant, you're talking about the physical, not the paper, such as GLD or holding it in something like that, which is really just a claim as opposed to the physical itself. Am I right in that?
No, absolutely. I mean, I talk constantly about the price of gold and the gold price, and they're two different things altogether. The gold price is the price of a spot futures contract on the COMEX. When people ask you, what did the gold price do today? They're quoting you the price of a piece of paper. The price of gold is what you have to pay to get an ounce of physical metal or a kilo of physical metal in your hand. And there's a difference between the two always. The price of gold tends to be trading at a premium to the paper because, look, it's worth more. And that's how this works. So, absolutely, I'm talking about physical gold. Not only am I talking about physical gold, but I'm talking about unencumbered, unlevered physical gold that you store outside the banking system. And the reason for that was writ large back in 2012 when Cyprus had the bail-in. We saw what happened in Cyprus. It's a tiny country in the EU. And as we watched that happen, I was astounded at the lack of realization by the vast majority of people about what had just happened. People essentially had a percentage of their savings stolen by the Cypriot government, under orders from the EU government. And so if you had your gold in a safety deposit box in a bank, you couldn't get access to it for a week, a month, who knows how long that's going to be. So having your insurance policy in a place that will be the first institution shut by governments should we get some kind of event is a dangerous thing to do. Having it in a safety deposit box outside the banking system, or if it's a small amount in a safe at home, somewhere where you are guaranteed access to it 24 hours a day, 365 days a year. And when you talk about things like this, people tend to kind of think, oh God, he's one of those guys. For the record, I'm absolutely not one of those guys. But I think, it's never been more sensible to be prudent. And, I hope to God I never ever need to use the gold that I have stored outside the banking system. I'd love to pass it on to my kids, on to their kids, as a wealth transfer that I've accumulated in my lifetime I can pass on to my kids. The point is being ready should you need this stuff. And a great friend of mine, Simon Mikhailovich in New York, who's also heavily involved in the gold markets, we were talking about this a couple of weeks ago. And he said, look, this is insurance. This is insurance. If you think about it as house insurance, he said, you have to have your insurance before your house catches fire. He said, because once the house is on fire, it's too late to buy insurance. Nobody will insure you. He said, the only people who can buy insurance right at the time of the blaze are the arsonists, because they know when they're going to set the fire. And to me, that was a great analogy, because the only people that know when you're going to really need your gold are the people who are going to make the rules at that time. And so if you're not positioned prior to these events happening, it's game over, I'm afraid. So it's a question of prudence, it's a question of caution, and it's a question of being prepared for the very worst outcome that you can imagine. And that's not to say it's going to happen, but not being prepared for it is a very, very dangerous thing to do.
The Austrians have a concept, Austrian economists, called the indirect exchange. And when you have excessive credit explosion that it always ends badly, the best strategy is indirect exchange, which is hard assets. Cash flow positive, generated, unencumbered assets. But gold and silver, clearly a store of value, and that's the essence there, is they will store the purchasing power and protect your purchasing power. But there are other asset classes too, are there not?
Yeah, look, absolutely. I mean, real estate is something that selectively it makes a lot of sense to own in times like this. The work I do here in Singapore, we've established some very good real estate holdings in Germany, where you have a country and a culture that don't own property, they rent. The average German stays in their home for 12 years. In America, it's 12 months. And so people tend to put money into their homes and they rent. And what we're seeing now is a group of house prices that have never had a bubble. They're basically flatlined because there isn't this rush to own them. But slowly and surely, it's starting to dawn on the Germans, hey, look, we're not getting any return on our capital here. It's going to start to make sense to own property. So you can buy properties in Germany at pre-bubble prices that will yield you 8% unlevered, in the teens if you put some leverage in there through mortgages, etc. Farmland is another thing we've looked at again, and this is trying to replicate bond structures, because if you look at bonds all around the world, they're egregiously overvalued. They're egregiously overvalued because people are worried in the terms of sovereign bonds and they're buying those as a store of safety, or they're egregiously overvalued in the sense of high yield bonds because people have been forced into this reach for yield because they're not getting a return on their savings. Something like a farmland, productive farmland, you have the bond component in the sense that you've got the capital and the land, and if you have a working farm that you can sell off the produce, you have a coupon coming in every year. And again, governments can't print farms. Now, you have to be very careful about the jurisdictions you own these things in, both real estate and farmland, and that's getting more and more difficult to do as times go by. The other thing is to invest in companies, and I don't mean listed companies. I mean real operating businesses where you can come in and invest. They don't have to be quoted on stock exchanges, so you don't have to suffer the slings and arrows of outrageous pricing. But you can find local businesses that do a really good job. They're not over indebted. They throw off great cash, and you can find real businesses. It's what capitalism used to be. People think capitalism is all about the stock markets. It's not. So it's difficult, and to find these things requires you going in the opposite direction to the way the general financial markets are going. And by that, I'm talking about the ETF phenomenon, where people sit at home and they have a great idea. I think biotech is going to be the next big thing. And back in the day, you would pour through balance sheets, you'd look at companies, you'd read research, and you'd find the best biotech companies you could, that you thought were best positioned to take advantage of what you saw as a surge in biotech, the biotech sector. Now you sit in front of your computer and you buy the biotech ETF, and it's lazy investing. It's easy investing, but it becomes very, very dangerous investing, because these ETFs become the market. As you see volumes come down, the ETFs that track the markets become the markets. And so by trying to diversify and think to yourself, I'm not the smartest guy in the world, I'm not an analyst, I'll just get a broad coverage of biotech stocks, and that way I'm bound to get the ones that go up. You're just concentrating yourself in the middle of the herd, and when things turn, the herd all want to get out, and you're going to be in the middle of that herd trying to get out like everybody else. So at the time when you really need to do your due diligence and look for, from a ground up, from a company perspective, as to what is a good company, a good business to invest in to generate cash flows, people are being steered in the opposite direction, and it's a very dangerous thing. So it's really hard, and it requires a lot of thought and a lot of hard work to do. But you're absolutely right. There are places out there you can find good investments, but they're not going to be the ones that pop up at you in your inbox from stock taxes.
Grant, we have to wrap. We're up at against our hard line. Any clear messages you'd like to leave with our listeners in summary?
Look, I think there's several. I think it's never been more important to be engaged right now. You have to pay attention, and you have to try and understand what's happening, and that's the big picture. You need to understand the hole that governments are in, and you need to understand what they're trying to do to get out of those holes. And you have to suspend your blanket confidence in what you're being told, because what you're being told is not going to help you in the long run, because there's an agenda here. And I don't want to sound like one of those crazy conspiracy theorists. And they all watch me and go, oh, here we go, he's one of those tinfoil hat guys. I'm honestly not, I promise. But I think needs must, and the situation is dire. And when situations become bad things tend to happen, and governments will do what they need to do, and they will rely on the fact that people aren't engaged and don't understand what's happening to allow them to do what they need to do. Now, in places like South America, in Asia, we've seen that through history all the time. People are instinctively wary of their governments. The West has had 40, 50, 60 years of outright prosperity, And so there is no fear, there is no mistrust in governments in the West. That's a very dangerous situation to be in. So be engaged, question what you're being told, and try and understand it. And the other thing I would say, look, be cautious. This is a time for caution. Don't be afraid to miss out on the next 10% of the stock rally, because if you miss out on the next 10%, but things for some reason stabilize and it looks like there's going to be another 20%, you can capture that. If you reach for every 10%, that last 10% turns into the first 20, 30% of a drop. And avoiding big drawdowns is what makes investors successful over the long term. You can't have a big hit to your portfolio because it takes a long time to get back.
Certainly does for those who lived through 87, 1999, 2008. And things may go up straight for 11 months, but they'll come down in 11 days and lose it all. Or worse. It's very, very rapid when it changes and you have panic setting in or collateral contagion or whatever. Grant, can you tell our listeners how they could learn more about your writings and the things that's in your investment solutions?
So I write a newsletter called Things That Make You Go Home. You can subscribe. If you email me at grant@ttmygh, that's thingsthatmakeyogohome.com. I can add you to the list. It's a free publication at the moment. I'm also one of the founders of Real Vision Television, realvisiontelevision.com, realvisiontv.com. And you can go there to see some of the finest financial minds that we can find in the world, talking frankly and without any kind of filter about their thoughts on financial economics.
Until the regulators start to get involved and say they can't say this and they can't say that. Is that a possibility?
Well, look, I mean, we're very careful. We're guys with a long financial background, so we understand the framework within which we operate. So we're very careful not to put ourselves in that position. And what we found is, giving people, like you do, Gordon, this is a great service where you give people, really give them time to go into their ideas and their thinking. And it's important. And people, as I said, need to be educated. And like you, we're trying to do our bit to bring the people that have the answers to an audience that have a lot of questions.
Grant, been an absolute pleasure. Enjoyed the conversation, and I'm going to have you back because there's so much more to talk about.
Anytime, Gordon. It was great fun. Thank you.
Thank you very much. All the best.
Yes.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.